If you've been watching the housing market, mortgage market this spring, you have undoubtedly felt it was a dud, a bad year. But I don't think you know just how bad it was. When you look at nationally, there's only one guy I turn to, and that is Lance Lambert from ResiClubAnalytics.com, aka Resi Club. I think we're going to have a conversation about just how weak the spring selling season was, and more importantly, what might this mean for the second half? Buckle up, folks. You're not going to want to miss this. Lance, how you doing, buddy?
Doing great. Housing. Always so much going on, especially in this unique market that we've been passing through the past few years.
Absolutely. One of the things I love about you is you put out consistent charts that we really could look at. You color code them. And I think there's a few that we're going to look at here that really just highlight how important traditionally the spring selling season is. I think this season, I've said all year that this year is going to be the worst year of this trough, right? Sub 4 million for existing homes. And I think you have some data showing how bad it was. But even on a price level, we started to see month-on-month negative numbers, at least in the last Case Shiller, I think it was. So, yeah, let's take a look at how bad it was and then help us look into the crystal ball. What might this mean for the second half?
Yeah, and I think before we jump into some of the numbers, I think the big picture to kind of zoom back out, and I know people hate kind of zooming back out and going back through past history, but a big picture, the U.S. housing market during the pandemic, during the early period of the pandemic, saw a very big increase in housing demand from the ultra low rates that really pulled in a lot of investors and a lot of properties cash flowed, and people kind of wanted to get those low rates. And then all the stimulus money that was pumping in, right? And then there's the fact of work from home, which even in the markets that lost population, San Francisco, Seattle, New York City, there was an increase in demand for housing and for space because there was all the decoupling roommates where people were working from home, and they would see their roommate, in like New York City 2 hours a day, and now they're seeing them 16 and they hate their guts, right? People wanting more space for offices, so getting a bigger apartment with more space. And then the other part of it is the work from home arbitrage effect. And so you have people who couldn't maybe afford or weren't getting much bang for their buck in places like New York, San Jose, Seattle, Los Angeles. And so they left, kept their income because they were working remotely, and bought in Austin, Boise, Tampa, right? And so all of that increase in housing demand, the Federal Reserve estimates to absorb it, for the market to absorb it, new housing starts would have needed to increase 300%. So going from 1.4 million housing starts to 2.8 is a 100% increase. Then over 4 million is a 200% increase. And then up to almost around 6 million to absorb it. That's not how the market works, right? There's only so many people at any given time that know how to do all the things that go into building a home. There's only so many developed lots that are entitled and ready to go. There's only so many supply chains for lumber and all these different components, window and drywall, right? So that can't happen. So what occurs when you have that big of an increase in housing demand in such a short window, because demand is more elastic than actual supply of the stock, overheating of prices, right? So not all of the demand that wanted to transact could transact, but the demand that was willing to pay the most transacted. And so what occurred is we had a bit of a pull ahead where you had some transactions that maybe would have occurred 23, 24, occur in 21, 22 as people kind of jumped at those low rates. But then because prices went up so much so quickly, and then it was followed by a rate shock, affordability just got very strained. And so in this market, a bit of it was a pull ahead where some of the transactions that would have been 23, 24 were pulled ahead. But then a lot of this churn is just not occurring that would have occurred because affordability is so constrained. So many buyers are priced out, and then also so many sellers who would then go buy something else, that churn in the market, priced out. And if they're not priced out because they can't afford it, they're priced out because they don't want to afford it, right? They don't want to they don't want to see their discretionary income chopped down $1,500, $2,000 a month, buying what might be a house that's the same almost, just in a different area. and even if you did, there's some people in this market that if they wanted to downsize and get a smaller house and maybe even a less desirable area, their monthly payment could be higher for that house than their current house, right? So affordability is just this very big strained issue on the market. And I don't want to get into too much, too deep, too big into the opinions, but I think it's fair to say from a lens of housing that 2021 was a policy failure, right? Where rates went so low, stayed so low as housing and the labor market overheated. And those last 6 months, really, we got more price growth than we should have if rates had been higher. And this market is just really unhealthy in dealing with that.
Yeah, there's no question that I've said for almost 5 years now that the Fed broke the housing market. And unfortunately, we're going to be feeling this for at least a decade, right? We're 4 or 5 years into this. And you're absolutely right. The move-up buyer, which, traditionally is an important part of our cycle because they sell entry level and then buy the next one, they're just not transacting at any numbers close to historical averages. And also turnover, right? The average turnover, historically was 7 to 8 years. We're now at 10. And I think that's even going to go higher because not only the purchases, as you're talking about, Lance, but we had a whole year and a half of refis where people took down their rates. And, today's shelter cost is artificially fixed low. To your point, people want to go downsize, but their payment doubles. They're not doing that. There's no chance, right? They have a fixed shelter cost because they took advantage of 2.5, 2.9, 3.1 rates. They're locked in for a long, long time.
And so I think a question that naturally an audience member might have is that transactions, right, for existing have been essentially about the same since the end of 2022, right? You get a little bump here, a little bump there, but we're at a very constrained level of turnover. But if you're in this market, the most significant noticeable shift is that we have softened, right, in terms of the pricing power. And that dynamic has moved more from sellers to neutral to even to buyers markets in some of these places. And the reason for that is that the technicals of the market, this, actual active inventory, months of supply, when rates shot up, we were at the lowest that we'd ever been for active inventory because that market overheated, was absorbing everything. And so as that rate shock occurred in 2022, we started to get some more actives, but we still came into the 2023 market with tight technicals, right? The supply-demand equilibrium was still enough in sellers' favor. But over time, as we stay in this slump demand environment for longer, slowly that supply-demand equilibrium is working more and more away from sellers towards buyers. And active inventory is building and months of supply have risen. Now, in some parts of the country, that's happened faster than others. The places like Austin, San Antonio, Tampa, down into Southwest Florida. And then, those are the places that have seen the most. And then just generally throughout much of the Mountain West and also the Sun Belt areas, the places that have more home building. And as builders continue to move that inventory, that creates a cooling effect on the resale market who has to compete with it. And then those places also, saw a pullback in the pandemic era migration boom. And so now they have to rely more on local incomes and prices went up more in those markets. Those things kind of create a bit of a bigger pull in terms of the supply-demand equilibrium moving from sellers to buyers. But generally, zoomed out, it is fair to say that we've been softening on an aggregated basis. And the root cause of this is just that we saw too much too quickly and overheated too hard at the end of the pandemic housing boom. And so the market is still coming out of that, right? And so how does the market heal going forward? The number one thing, whether you're bullish or bearish, I think everybody could agree, is time. It takes time to work through this.
Nobody likes that answer, Lance. Everybody hates that answer, but it is the right answer. This is time. Yes.
It takes time. And so as time plays out, some of the markets that are going to have to go through corrections, some of the Southwest Florida, some of these markets in Texas, they are, right? That's a part of their journey to it. Time also gives another key ingredient, which is incomes rise.
Wages. Yep.
incomes have not stopped rising. They've been
No,
rising. They're
correct.
still rising this year. And so if you get into a scenario where on a nationally aggregated basis, let's say home prices go up 1%, they go up 0, they go up -1, like we saw in the early 90s, and then incomes still go up 2, 3%. But the marginal buyer, that person who's actually going to buy, who's in their 30s, their income could be going up 20%, right? They're
Correct.
getting bigger jumps. And so as the income rises, that will bring some turnover back into the market because, yes, there's still going to be a rate shock of somebody selling to buy something else, right? That payment. But if their income has risen, and so on a discretionary income percentage, it's decreasing for their percentage of their budget, they'll become more and more willing to do it, right? Those lifestyle events build, that will bring it in. And then the other thing is, while you've seen this market shift and you've seen more slack come into the new construction market, you had not yet seen a big pullback in single family home building. Yes, there's going to be some of that, especially in the build to rent market that's kind of rolling over from the peak, but there's still builders building and they're compressing on margins. But as that supply continues to move in, that's helping to ease this affordability strain. And we see that in the real market where the places that do have the home building have kind of eased up more. So I think the really big thing here is time and what the actual picture will look like and how all this kind of plays out. That's kind of a little tricky. And I think, if anybody's, like all of these, can spell it out exactly how all of it will work out, I'm skeptical. But I do think the biggest thing is just time will work this out. And so I think also for the SFR investor, as we go through this, right now, this has just been a constrained period for institutional deployment into the space because prices haven't come down more, rates are still high, capital markets are kind of tightened up, and rent growth has really decelerated. But the thing that makes it more appealing over time is if, let's say, we did go through a period where prices soften a bit, right? And then that creates maybe some upside long-term for HPA, right, to start to come back. And really the key there is to improving the SFR market is rents to rise. Rents are really the thing that needs to, rents are where you can really change the math on the SFR investment. So, but I think generally speaking, the institutional side and SFR deployment, this is just a constrained market for them in particular because they're not just trying to find a deal. They're trying to be able to find scalable amount of deals that can have returns that compete with other yields they can find throughout the economy and throughout financial.
Couldn't agree more. All right, let's look at some of the numbers. And again, I think it's really important for people just to realize how weak this spring selling season has been because this can be a harbinger of what's to come. I know you have a lot of great data here, so let's jump in.
Yeah, so this is my table that I do for my Resi Club Pro members every month, and this is showing month-over-month appreciation.
Could you zoom in a little bit or no? Do you have that ability? Just a little bit bigger? Oh, look at that. You're fancy.
I don't know. Did that work?
It's a little bigger, yeah.
Okay. It's probably going to be a tough chart for a video because there are a lot of numbers in here. But I love this chart because it tells the truth that anybody in the real world housing market knows and has known for a long time.
Focus on the colors, folks. Don't worry about the numbers. Worry about the colors because the colors tell you something.
Yeah. And so what happens in housing every year historically is that on a nationally aggregated basis, coming into the year, you start to get a little bit of upward momentum, right? It starts initially as new listings start to rise coming into the year, then existing home sales start to rise, and then appreciation comes after that. And what we are seeing in this spring market is we're definitely softer on a nationally aggregated basis. This 0.7%, which is actually rounded up to that, a little bit below the national average. But if you look at the trend line for appreciation, when I was doing the numbers, it looks the most close to 12 and 10 when I was doing the lines of this last night. Now, those 2 years are two very different years. Where
Yes.
2010 is the year that we started to get some uplift in housing after 07, 08, 09, and
Mhm.
then the spring market busted out, and we just had a bad end of the year. There was more, like, I believe there's more tightening of mortgage standards here too.
Correct. Yes.
Well, and some of that stimulus money had helped to kind of lift it for a second, right? Some of those first-time homebuyer credits and all that stuff, and then the market fell back down. And then 12, that's the start of the recovery.
Yeah.
And these nationally aggregated numbers, and you would know this better than anybody, in some parts of the country, they saw a huge jump up in 12, right?
Oh yeah, they were 3, 4, 5%. Yeah, for
Yeah,
sure.
this is probably more like your market, right?
Mhm.
The ones that really got hammered in the bust because
Yep.
the smart money knew that those places were the best opportunity for investment. And
Agreed.
in 2011, there was not a single institutional group or single owner of more than 1,000 homes, single family in the U.S.
Mm.
And within 18 months, Blackstone had through Invitation Homes 25, 30,000.
Wow.
And I did a little more digging because I've been trying to figure out why Atlanta in particular. And one of the things that was interesting about Atlanta is that they would have Super Tuesday auctions, is what they would call them, where instead of doing auctions all throughout the week, they would have the one day. And it was just easier for institutional capital to kind of come to
Yeah.
that one day, right, and buy up,
Makes sense.
a ton of these at one time. So that's a part of the reason for Atlanta. And so what you see here is a weaker amount of spring appreciation. And so what that's doing is it's creating a deceleration in nationally aggregated prices. So this yellow line here, if you can see it,
Mhm.
this is the national aggregate for home prices in the Zillow Home Value Index. And I should say that among the indices, the Zillow Home Value Index is actually the softest right now. And I think that's for two reasons. And so right now, Zillow is up 0.7, so just under 1% year over year for national prices. Whereas like Case-Shiller's 3.4, FHFA is 3.7, CoreLogic, which is now Cotality, is 3. And then like Black Knight and some of these others are kind of like 2. One of the reasons is that just Zillow's ahead. They just stay a little ahead of the repeat sales indices. And then
Mhm.
the other factor is that this Zillow index I'm using here is single family and condo, whereas
Gotcha.
Case-Shiller is just single family. And then Freddie Mac is just like Fannie Mae and Freddie Mac loans that are single family. So
Makes
that
sense.
would create a little of the deviation. But either way, if you look at them all, and I do have another one that I put them all on together, you can see that we're decelerating right now.
Yep. Yep.
And and so this is year over year prices. You can see the greatest softness, right? Gulf that we've been
Yep.
talking about, Southwest Florida, Punta Gorda, Cape Coral. You can see, the Northeast has a little bit more to it, and then the West is actually where things have been the most interesting because the West got a bit of a bounce back in
Mhm.
2024, and now they've really softened out West.
Yeah.
And it's not necessarily seen the falling that we're seeing in like the Gulf, but you've definitely seen weakness come back into the Western markets. And California now is about back to pre-pandemic 2019 inventory levels.
Yeah, I talked with Adrian, Orange County, Beth, Seattle, King County, and yeah, both of them are talking about this spring selling season just being a dud, softness, seeing inventory really stack up in the luxury market. So yeah, it's been a bad spring for lots of people.
And that's something that's interesting to point out is right now, if you hear about like luxury or single family or sorry, entry being better or luxury being better, the truth is right now, there's a lot of bifurcation there too, where
Yes.
in some parts of the country, the luxury is better, and then others, the entry is better. And then there's
Mm.
other places it's completely flipped. There's just a lot of variation in this market right now. And so this is probably the most interesting visual in this. And let me try to see if I can make it bigger. On the left is the year over year map from
Mhm.
last April. So
Got
April
it.
23 to April 24. you can see there's a lot more blue, right?
Yep.
More dark blue. Like there was still more of that heat, the technical still being tighter, right? And the golf is where you saw that weakness. Fast forward a year, golf is where you see still the most weakness, but it's spread and really Florida, right? And then everywhere has just lost moment, is just decelerated, right? It's across the board. There's actually only one market in the country that has stronger, relatively speaking, appreciation or year-over-year growth than a year ago,
Oh,
and
wow.
that's New Orleans, which
Oh,
was down 7% a year ago, year-over-year, and is now only down 2.4. And so that's one of the weakest markets, but and
yeah.
I think one of the only reasons that it's not down as much is because it was already down, right? So,
Correct. Yeah, it makes sense.
but everywhere is decelerated, and the places that I considered strong last spring, the Milwaukees, the Detroits, the Rochesters, the Hartfords, they've really all decelerated to plus, from Milwaukee +7 to now +3, Detroit from +7 to +2.8, Rochester from +9.6 to +4.7, and then Hartford from +12.3 to +4.4.
Yeah. This is all painting a picture. Again, we're supposed to be in the historically strong months. I think it was Redfin over the last week or so came out and changed their forecast one more time, now calling for -1%. Was that Redfin that did that?
Yeah, Redfin did that. Zillow has kind of they came down to like 1.7-ish, and now they're like 1 on their 12-month rolling one. But the Zillow Home Value Index only has 0.7% year-over-year appreciation, and there's a clear deceleration there. So of the national ones that go negative first, it would be the Zillow Home Value Index.
Okay.
We are seeing the month-over-month adjustments for Case-Shiller and FHFA, seasonally adjusted being down month over month. Now, without seasonal adjustment, they're still up month over month. But what that means, the model is telling you that if we stay at the current trajectory, as we move out of the spring market into the seasonally soft window, we're going to see more give up than normal. And if we maintain where we are right now, we will at some point be negative year over year for national appreciation for those if the model doesn't move out of where it is right now. And so I think all the signs are telling us that this was a very weak spring market, right? It was constrained for resale turnover still, which has been the case since the end of 2022. Now, because the actives of the market, the technicals and months of supply have moved more and more from sellers' favor to buyers. That's really decelerated appreciation and caused more markets to see, even some outright declines. And then on the builder side, if you look at the new home sales, the prints aren't bad. They're not bad. But if you look under the surface, and I think you probably saw my report that I sent out earlier this week, the reason is builders are just doing even bigger margin compression, right?
Correct.
They're doing more, and the buy downs have lost some of their magic. And so they're having to do more of like the money at close, outright price cuts and things like that to juice things.
Well, it was, I forget which CEO said this. I'm sure you'll remember. Pace over profit.
Lennar, yes.
Yeah.
Lennar. And they've seen the greatest compression in margins. But of the 10 biggest builders I track, 9 had compressed margins or lower margins for Q1 than last Q1. And the one that was an exception, it was just the exact same level of margins.
Wow.
And now some of that margin compression is also that land prices have not, they've still been going up. And so that's affected margins. And then, to a tiny degree, some of the material cost stuff here and there. But really the material costs, I don't know if you saw the chart I put out this week, material prices are only up 2% year over year.
I did see that.
They haven't been, and some of these commodities are down. The biggest issue is aluminum. That's up like 18% year over year. And I think if some of these tariffs were to stay in place, I think some of the appliance type stuff could become a bit of an issue.
Sure.
But I think with tariffs right now, if you look through the commentary from the builders for fiscal year 2025, it's not as big of an issue. And if anything, there's been lower demand for materials because we've seen such a rollover in the multifamily side of
Yep.
construction, which has really just outweighed significance in the market versus tariffs to this point for construction materials.
I love this. Housing, housing, housing. Lance, you are amazing. Where can people go get and sign up for your free newsletter?
Yeah, so if people want to sign up for my free newsletter, go to ResiClubAnalytics.com, put in your email. You'll get a few articles for free every week. And then I also have a premium service called Resi Club Pro that gets more housing research, more access to my data and tools, and then my monthly webinar that I do.
That's awesome. I love the fact you added that monthly webinar. That is such a huge get for the pro members. Lance, you're amazing. Have a great week.
Thank you for having me.
Mhm.